If you own an investment property, your insurance premiums are likely to have skyrocketed since COVID-19 hit. And the changes don't stop there. Ever wondered why your property's insurance suddenly doubled? It's not just inflation. COVID-19 triggered a chain reaction in the insurance world, and there are 4 hidden changes you need to know about. Today, I'm pulling back the curtains on what your insurance companies may not be telling you, and how to make sure you're not paying for things that you don't need. While inflation has certainly played a role, the truth is that insurance companies are dealing with their own soaring costs behind the scenes. Construction and material costs have gone through the roof since COVID, with labor and supply chain issues driving up rebuild expenses by over 20% in some markets. At the same time, insurers' borrowing costs have skyrocketed as they've had to pay higher returns to keep investors on board after the pandemic uncertainty. This perfect storm of increased expenses means insurers had to offset those costs, which gets passed along to you through doubled premiums for property coverage. But there's another reason premiums have spiked that may catch you by surprise. The events of the past few years triggered a sweeping review of the insurance industry during the Financial Services Royal Commission. New regulations were implemented, demanding insurers provide more transparency around their policies and coverages. This means in addition to the standard product and disclosure statement, insurers now have to provide retail clients, like property investors, with a target market determination. Essentially, they are spelling out exactly who they designed each type of insurance policy for. On top of that, there are now far fewer insurance underwriters operating in the property market. A combination of the pandemic risks, increased costs, and regulatory changes caused many insurers to simply stop offering investment property policies altogether. With less competition, the remaining insurers have even more power to raise premiums at their discretion. And that's not even the biggest issue property investors are facing. In the wake of COVID-19, insurers took drastic action that directly impacts your coverage and ability to make claims. One of the first major changes was the removal of rental default cover across the board. For years, this important protection allowed you to claim for loss of rental income if the tenant stopped paying. But when the pandemic hit, insurers swiftly stripped this cover from all policies, leaving investors exposed. While some companies have slowly reintroduced rental default cover, the rules around when and how you claim have become much stricter and more limited. But that wasn't the only way insurers moved to reduce their own risk exposure. In addition to stripping rental default coverage, the second change is that many property policies now come with reduced cover or coverage being removed altogether. This allows insurers to limit their potential liabilities. For example, some policies no longer cover for things like malicious damage by the tenant or have drastically increased the deductibles and out-of-pocket costs you'd have to pay. Even more concerning is the third change on our list. As the cost to replace your property increases, there are chances you are underinsured. If your property is underinsured and you make a claim, some insurers will now only pay out a percentage of the total loss rather than covering the full amount. So not only are you paying more for less coverage, but you could also get stung when making a legitimate claim. And just when you thought it couldn't get any worse, on top of all these policy changes, new tenancy legislation has thrown another wrench into the mix for property investors, bringing me to the 4th change. Laws now heavily favor renters' rights in many states. Things like allowing tenants to have pets and making minor modification without your consent as the owner, or preventing you from evicting tenants without a valid reason, like breach of contract. These tenancy law changes increase the potential risks and damages to your property that may not be fully covered by your existing insurance policy, leaving you to foot the bill out of pocket. But perhaps the most concerning of all is the fact that many investors are unknowingly underinsured for their properties. So, what can you do about it? The first crucial step is reviewing your property's insured value and replacement costs annually. Construction costs have skyrocketed, so the amount that you insured for even 1 or 2 years ago is likely well below what it would cost to rebuild today. Rather than relying on your insurer or your broker's estimate, get a professional valuation report from a qualified quantity surveyor. They can provide the most accurate replacement cost calculations by factoring in the current market rates for labor, materials, and other factors specific to your property's location and characteristics. This ensures that you have sufficient coverage if you need to make a claim. It's also wise to scrutinize your policy's fine print around co-insurance penalties for being underinsured beyond a certain percentage. Increasing your coverage amount can help avoid those financial penalties. Additionally, you may want to look to choose a policy to cover for pet damage or accidents caused by minor renovations. Updating your coverage prevents those new risks from falling through the cracks. By taking these proactive steps, you can maximize your protection as an investor in today's rapid evolving insurance landscape. As an investor, ignoring these realities could severely impact your portfolio's cash flow and leave you financially exposed if you need to make a claim. If you'd like to review your insurance policy with an experienced professional, feel free to reach out to the Duo Insurance team. If you liked the video, please like and subscribe. Good luck on your investment journey, and I'll see you in the next one.